Gina, let me begin with you. Set the scene for us as we come into the final trading week of 2025. What are you expecting?
Well, obviously, we have had a bang-up year, and that looks to continue. I think this next week is just going to continue that trend. It has been driven by AI, despite concerns that it might be overvalued. The reality is that the infrastructure play and so much of that story has yet to continue to unfold. So I think that continues to power us through the end of the year. I think as we look into 2026, our big concern is around inflation, which has been moderating, but we think that there's sort of a limit to that. And some of the things that you described are inflationary. I mean, oil will potentially be inflationary if we get into any kind of contracted anything around that. But the reality is that the stage is set for a lot of inflationary pressure that had been bubbling on the backdrop of a consumer that has gotten weaker and weaker over the years. So even though we're going to end the year strong, I think we have some caution going into 2026.
So I hear some concerns about inflation, some questions over the AI trade. Justin, does that match how you're setting up for 2026?
Thank you, Contessa. For 2026, I think there's a wide range of possible market outcomes. I think that inflation is probably more contained, and I'm more concerned about the strength of the consumer and the job market. I could see inflation constraining the market multiple as we look into 2027. And so I'm investing more based on an expectation, or I should say an average expectation, of a flat market plus dividend returns after, the strong run in the last few years.
The fact that you're looking so much at the consumer here, is it a bifurcated consumer again, like this tale of two consumers, Justin, where you've got the affluent just cruising along and spending and perhaps propping up what we're seeing in terms of corporate results, and then that lower end consumer who's really feeling the pinch, potentially from tariffs as well, one of the things that we haven't been diving into quite yet?
Yeah, it certainly is a bifurcated consumer, but the overall job market isn't that strong. And of course, the spending by the higher income, consumers is somewhat tied to the overall market level. So that creates another kink if the market should, sell off modestly or moderately, as we tend to see in midterm election years at some point in the year, even if the overall, year ends up pretty well.
Gina, we've seen these corporate balance sheets looking fairly strong. How much of that is due to the strength of the consumer?
So I think if you look at what's been driving consumer, I want to go back to your question about the bifurcated, the K-shape. We see definitely a K-shaped economy, and we see that actually resulting in different companies experiencing different outcomes. And so, yes, I agree that the consumer has been powering balance sheets, but that has also been a lot of business spending as well. And the consumer, meanwhile, has racked up credit card balances to levels we haven't seen in a very long time. Which is to say that they can only do that for so long, especially, even if we see some further rate cuts this year. I don't think it's going to be enough to deal with the carrying cost of what the consumer has amassed. So while that has been a 2025 experience, I think the 2026 experience is going to be moderating spending.
Okay, so given that, where are you looking to put your money at work, Gina?
We are actually very focused on the AI infrastructure play because even though we feel like we are unquestionably in, a bit of a bubble, just like the internet had a bubble, but it didn't go away. It became a part of our lives, and we think that AI and continued machine learning is going to be a part of our lives, and the spending that is going into the infrastructure side of that part of the market isn't actually as overpriced as, let's say, applied AI or other segments of the market that are just sort of working on top of these innovations. But if you look at the cloud computing components, anybody selling chips, anybody making chips, anybody designing chips, that whole segment of the market is actually still not as overpriced. And we see that spending, and that spending is not as dependent on the consumer and is really more a business infrastructure decision over the next 2026. We think that continues, and that's a big component of what we're focused on.
And Justin, I see that one of your focuses here is a company called Belden, which is more about automation and robotics as a play on AI.
Sure. Yeah. So we are bottoms up value based stock pickers, and a name that we like is Belden, which is St. Louis based, 5 billion market cap. It's a beneficiary of North American automation spending, getting 2/3 of its EBITDA and half its revenue from automation spend. But it's also making inroads into solutions for data centers and agentic AI in the industrial manufacturing setting. Trades, quite inexpensively at 11.5 times 2026 EBITDA and 15.5 times earnings, and certainly can re-rate upwards versus other automation names that, are more standard automation names that trade at significant higher multiples. So, you put a 13 times multiple and a high teens EPS on the stock, and you're probably looking at $160 stock out 2 years with good long-term trends.